Ladies and gentlemen, good day and welcome to the Q4 FY’25 earnings conference call of Chennai Petroleum Corp Limited, hosted by Yes Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on the touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Harshraj Agarwal from Yes Securities. Thank you, and over to you, sir.
Thank you, Tuja. A very good evening to everyone. I would like to extend a very warm welcome to all the participants and the top management of Chennai Petroleum. So just to highlight to you who all are present, we have with us Shri Rohit Kumar Agrawala, Director of Finance, Shri Anil Sahani, Chief General Manager, Technical Services, Shri A. Dharmaraj, Chief Manager, General Manager, Finance, and Shri Shrikant, Chief General Manager, Technical. So I would like to hand over the call to the management for opening remarks, and post that we can move on to Q&A session.
Good evening, everyone. I am Rohit Agrawal, Director of Finance, Chennai Petroleum, and with me, my senior colleagues are Anil Sahani, Chief General Manager, Technical Services, Mr. Dharmaraj, Chief General Manager, Finance, and Mr. Shrikant, Chief General Manager, Technical. First of all, I must thank you all for joining this call today. On behalf of CPCL team, I welcome you all to this post-Quarter 4 Financial Year 2024-25 result Concall. Before we begin, I would like to mention that some of the statements that we would be making during this Concall are based on our assessment of the matter, and we believe that these statements are reasonable. However, the result would be different depending on the number of events and uncertainties. Our Q4 Quarter 4 2024-25 results are with you for quite some time now. I hope all would have gone through, would have done their own analysis. And during this call, I'll be happy to take questions based on the same. To start with a brief summary from my side, during this quarter, our refinery continued its stellar performance, both on physical as well as financial parameter. I'd like to highlight some significant developments as we step into our Diamond Jubilee year. This being our Diamond Jubilee year, CPCL has been upgraded from Schedule B to Schedule A Central Public Sector Enterprise by Government of India during August 2024, which brings in, which enables us for a lot of freedom in recruitment as well as going forward board powers into our operations. Now let me start with the physical performance. CPCL achieved a crude throughput of 10.45 MMT, that is equivalent to 99.5% of our installed capacity. And this must be seen with respect to the turnaround that has happened during the year. And if you take that consideration, again, you will find that this performance is quite comparable to the previous year's performance, where CPCL clocked 111% capacity utilization. And if I keep my focus only on Quarter 4, the crude throughput was 2.974, which is 113% of installed capacity. Again, that reinforces that performing much beyond our rated capacity is now a norm, and CPCL is capable of that repeating year after year. The next I like to state, the lowest ever energy intensity index registered during the year further underlines the optimized energy utilization. I must place it that if you remember, our energy indexes and our fuel and loss indexes were quite high 2-3 years back, and we went to a roadmap where we said on a sustained basis, consecutively, we'll bring it down to very efficient levels. And in that context, the fuel and loss has come down to 8.5%, for a year as a whole. The MBN is at around 72.0. The best EII is a figure of 87.4 has been clocked in the current year 24-25. With respect to value-added product, we in the basket of food grade hexane, we have now added pharma grade hexane of equal capacity, and that has also reflected in our sales, where products like hexane, MTO, lean butane, the sales have increased in this current year. With respect to RLNG and our commitment to net zero, RLNG consumption during the current year, during the previous year, that is 24-25, was 527 TMT, as against 441 TMT in the previous year. It must also be highlighted here that even the previous year was the ever best, and much above earlier years. And, so we look constantly at this space and, based on our economics, we try to, increase the RLNG quotient for overall profitability and environmental sustainability. During the financial year, we have processed almost 64-65% of high sulfur. Our long-term sourcing remains at around 55 to 60%, and the spot and the opportunity crudes depends on individual economies, and we try to harness them, increase them to keep the profitability, at the best. Pharma grade hexane we talked about, so that's a new product that we introduced during the year, which gives us inroads into a new market altogether. We also did a trial run of SAF, Sustainable Aviation Fuel, so we will be one of the few players who will have a early roll, who has a possibility of an early rollout of SAF. Safety is pretty critical in an industry like this. Again, we are happy to share that the zero fire accident incident is continuously upgraded, and we continue to have it. Now it's almost 1884 fire-free days as of March 31st, 2025. To summarize the physical performance, we are committed to develop new schemes on energy efficiency, further take the fuel and loss reduction roadmap further lower, and then develop and enhance production of value-added products as well going forward. Now I turn to financial performance. The GRM for 24-25 for a full year basis is $4.22 as compared to the previous year 8.64. But if you compare it to Singapore benchmark, the Singapore benchmark was 3.79 in the current year. We all know that product cracks have reduced as compared to previous year in the international market. But our endeavor to better the benchmarks continues. If I turn to quarter 4, the GRM was $6.22 per barrel. Again, if I compare the previous year same quarter, it was $7.7 per barrel. But if I compare to Singapore benchmark, the Singapore benchmark was only 3.1. So you can the efficiencies would be evident, and when we go further, we'll also explain where from these efficiencies are coming. We have been continuously giving a premium GRM return over Singapore GRM, and if you ask why it is coming, post our shutdown, maintenance M&I, scheduled M&I, our refinery production has come back to much above scheduled capacities. Our fuel consumption are at the lowest possible on an incremental quarter-on-quarter basis. Fuel and losses are at the lowest possible, and then efficiencies are to the max. When I turn to leverage position, the leverage position, debt equity position as on March 31st, 2025 is 0.39 compared to 0.232 in the previous year. At an absolute amount, the debt stands at 3,100 crore as compared to 2,762 crore. Net worth hovers around 8,000 crore as on March 31st, March 2025. With above, the board has also recommended a dividend of 5 rupees per equity share, that is 50% of the face value for the current year. And as we all know, this is subject to approval at AGM, which will happen in the due course. On the capex front, in the current year, we have spent 673 crore as capex for the current year. Our maintenance capex remains 200 to 250 range. Next year forecast also we feel the capex will be in that range, and the maintenance capex will be at around 200 to 250 range. And depending on value-added projects, the actual will be a little different. On the governance front, I am happy to share that we have successfully implemented the Information Security Management System, ISMS, and certified for ISO 27001.2022, enhancing our system security robustness. The relevance of I am pointing out here is we are very aware that in the present systems, beyond the normal safety of the plant, the system safety, cyber security are of importance, and the company gives proper attention to that. Another highlighting factor on the governance front I would like to highlight is CPCL started with the IR reporting annual report in the IR reporting framework in 22-23. Immediately we are among the select few who in 23-24, immediately next year we got it assured. We were the select few who started IR with assurance. And I am happy to share that now we are part of the S&P Global ESG score, and CPCL has achieved a score of 46 for the year 24, which is above the average Indian average in this field. And the point that I would like to highlight is this is a journey that we have started. Governance, transparency, governance is one of our cornerstone, and we'll keep this momentum forward. Finally, the uncertainties due to volatility of crude prices do pose a challenge. We are seeing whatever be the direction, but yes, the volatility remains quite high. With these are broader factors that may drive volatility. We remain focused on things we control, that is fuel efficiency, capacity, and will operate our refinery efficiently in a safe, reliable, and environmentally responsible manner, and continue to focus on key metrics of controlling the operating costs as well as maintaining capital discipline by adhering to optimum return on value-added and growth projects, and thereby honoring our commitment to create long-term value for shareholders. To summarize, we continue to deliver resilient operational and financial performance and see the momentum to continue in the new financial year as well. Thank you once again. Now we are open for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Yogesh Patil from Dolat Capital. Please go ahead.
Thanks for giving me an opportunity. Sir, your GRM premium to Singapore, is there any inventory gains during the quarter which help you to post the better GRM?
The inventory gain is not very significant for the quarter. It's only $0.66, and in absolute rupee terms, it is 125 crores only.
Okay.
But on an overall basis, annual basis, the inventory would be a loss. That is $0.06 per barrel, 40 crores in rupees amount.
Oh, thanks, sir. My second question, as you mentioned, sir, your long-term crude sourcing is 50% to 55%. Can you provide us some details from which countries you are getting a long-term crude sourcing and any discounts you receive from the same?
So I'll tell you broadly what is happening. So we use in our long term a lot of Basra heavy, Basra medium kind, and then ADNOC grade crudes. So those are there, and these are based on OSP prices. But looking into our configuration, we have optimized. On an overall economics angle, also these are the best suitable crudes for us, and that is how we have kept them in our long-term basket.
Okay. If I'm not wrong, sir, Basra is a Iraqi crude, and generally Iraqi provides $2 to $3 per barrel kind of a discounts to the Indian crude basket or general benchmarks. If I'm not wrong, correct me.
And it may not be exactly same. Normally, the way I understand, one of the OSP, maybe the ADNOC or something, they take a lead and others follow. but there is no clear distinction of $2-3. But as I said, more than the pricing discount, the type of crude suits us in our economics based on our configuration. That is how we have kept them in our long-term basket. We prefer them.
Okay. Sir, my third question is again the refinery expansion plans at Kaveri. So can you update us on the revised project cost and the completion and the commissioning timeline? And post completion of this refinery project, how refinery product slates will change?
Okay. So let me tell you some updates on the project. On the CBR update, actually, in the last year, we revised the capital cost as well as the capital structure. The revised capital cost is at 36,354 crores with a 25-75 equity holding between 25 for CPCL and 75 for Indian Oil. Some of the most important updates with respect to project is now we have full custody of the land. So 600 about acres which was already with CPCL and another 600 acres which was acquired in the process. Both have been, the new one is also in our position, and the, pre-project activities of boundaries, all those things are almost at a peak stage. We were awaiting CCA approval. That process is on, and we expect, in few months, some more updates will come in that respect. With respect to product slate, this new refinery had a 6% PP, petrochemical index, of 6%. Others were broadly in line with normal standard. Only thing, this didn't have any naphtha or, that way. The slate didn't have any naphtha that way. That was on the product slate side.
So, sir, 6% petrochemical index includes which petrochemical products? Any broader idea on that term?
PP, polypropylene.
Okay. And sir, lastly, the post-completion of this refinery, what kind of a debt levels or debt to equity levels we can expect?
See, this is a separate JV. So the JV will have a separate debt equity and financial. Presently, we are working with a 1:2 debt equity for this JV.
Okay. Thanks a lot, sir. This was really helpful.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Kishan Mundra from DAM Capital. Please go ahead.
Hi, sir. Thank you for taking my question. Sir, can you highlight if there are any expansion plans in your existing refinery, whether in the form of CDU expansion or petrochemical integration? Thank you.
So, because this is a very old refinery, a significant capacity expansion may not be on anvil immediately or may not be sustainable. But as people say, multiple refinery exists within a refinery. So there are a lot of schemes which debottlenecks, which improves. That in a quantity terms it may not be much. But I would like to highlight one more thing. LOBS, lube oil base stock, LOBS 2 and 3. This proposal is at a very advanced stage wherein naphtha and HSD will be upgraded to LOBS 2 and 3. And this seems to be a very profitable project, and we are geared up based on approvals. We can take up this project quickly, and that should be profit margin accretive.
Understood. And just one more question. So in that context, can you highlight your capex guidance for the next 2 years, and would that capex guidance also include this particular capex, this particular project?
I'll tell. So the normal maintenance capex for the next 2 years would be around 250 to 300 crores. Maintenance capex plus small regular capex normally. And with this project, another 400 to 500 crore you can add for each of the year. So without this project, about 300 crore per year. With this project, about 700 to 800 crore per year.
Okay, sir. Understood. Thank you, sir.
Thank you. Participants may press star and 1 to ask a question now. Anyone who wishes to ask a question may press star and 1. The next question is from the line of Sunit from KPL. Please go ahead.
Hello, can you hear me?
Yeah.
Yeah, so a couple of questions here. One is, when is the next major refinery maintenance scheduled? And what was the expense in the major maintenance that happened in September, October last year?
In 25, I think our refinery crude unit 1 will go into, which caters to lubes, will go into maintenance around August, September. But yes, for more detail, I'll ask Mr. Anil, to tell about the current maintenance, current M&I which happened in the current year, which you asked, as well as some details about this maintenance.
Good evening. In 2024-25, we had a maintenance shutdown of one of our crude units. We have 3 crude units. So one of our crude units and some important secondary units like delayed coker, FCC, etc. went for scheduled maintenance. That has been successfully completed. In the current financial year, one of the other crude units will go for maintenance along with the lubes block as such.
Okay. Other question is, are there any plans to set up, plan to upgrade low-value products like petcoke to higher-value products?
So, as we said, that's a journey we engage continuously. Last year, we upgraded, another capacity in terms of pharma-grade hexane. Now we are looking at SAF, again for premium. So, similarly, we have few more products, but LOBS is at an advanced stage, and that is what I mentioned. But yes, as a refinery, which continuously in work for various other value-added products which are in the fray.
Okay. And other question was regarding the dividends, like is the inventory loss and the maintenance shutdown the only reasons why the dividend has come down so much?
No, dividend has not come down because of maintenance shutdown or any other factor. Dividend has come down because of the profits. When we compare the last year profits and current year profits, there is a significant change. And if you see the primary reason, international cracks, the cracks which were there at about close to about $13 to $15 in HSD, and others, came down to 10 or sub 10 level in the current year. And that's not a specific phenomena with respect to CPCL. That's an industry phenomena which has happened.
All right. Thank you.
Yeah.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Yash Nandwani from IIFL. Please go ahead.
Thanks for the opportunity, sir. Sir, I'm not sure if this was shared earlier. So could you please confirm the share of Russian crude in fourth quarter of FY'25 and how it is trending in first quarter of FY'26?
So, I'll term it as opportunity crude. And opportunity crude, I think on a full year basis was around 30%. Not very significantly different from earlier years. But going forward, the opportunity crude basket may not change, but the composition of opportunity crude basket may change because now we are getting, some good offers in other opportunity basket like US, African and others. So, because we have about 55-60% term, that leaves us another 40%. And normally we keep around 30% plus minus 4-5% for our opportunity crude evaluation. So depending on whatever crude is most beneficial in economical terms, suiting our technical requirement, we optimize that type of crude.
Okay. And sir, also could you provide some color on the discounts on our opportunity crude in fourth quarter?
Yes, I'll tell you. On an annual basis, if you ask me, the average would be little less than $2. In the last quarter, it would be less than $1, but intermittently there were $3-4 also. And now if you want what is happening now, again that $1-2 seems feasible with little bit of whatever we have done now in the current year.
So current discounts are close to $2.
Not on all, in some of the time. At times we are getting even 0.5, at times we are getting 1, but even 2 is feasible.
Okay, sir. Thank you.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Nalin Shah from NVS Brokerage. Please go ahead.
Good evening, sir. This is Nalin Shah here. First of all, I think the Q4 results were, quite encouraging. But we just failed to understand that how do we actually project once we look at 23-24 performance versus 24-25, it's a vast difference. So we are unable to really understand. And as you mentioned that, it is the cracks which decides the profitability and the this thing of the company. So if you can just give us some guideline that current year, how do we expect something on the lines of 23-24 or it could be 24-25 kind of a situation?
Yeah. So I'll try my best and I'll give you some broad guidelines how to evaluate CPCL, and how to project.
Right.
So one point, whatever I said you also reiterated is very, very true. That, what a refinery earns is the difference between crude and product prices internationally, because our prices are import parity, international parity prices. So if and normally people take HSD as a benchmark because that's almost close to 50% of the product slate. Though HSD, ATF, MS, these are 3 prominent figures. And if international cracks are higher, the profits will be much, much higher. And if it is lower, the profit will be lower. The second factor, which is very important, is M&I shutdown. If there are large M&I shutdown, that much of product availability, processing availability is not available, so that affects it. Plus, every shutdown, M&I shutdown, also involves startup and shutdown cost. So the operating cost also remains little elevated. Now, if I compare the previous year and last year for CPCL, in year 2023-24, we ran into our full capacity. Because the maintenance shutdown happens in a cycle of 3 to 5 years for a particular unit, there was no maintenance shutdown of any of the units in 23-24. But in 24-25, as CGM Technical Mr. Anil explained, we had few primary and few secondary units which went on maintenance shutdown that affects efficiency, that affects availability of processing and availability of product. Now when you look forward, 25-26, the impact of shutdown that will happen in the current year is lower than that happened in the previous year. There is 1 unit shutdown, 1 primary unit. If you make a single index, it will be lower than what happened last year. So you can expect a throughput which is higher than last year on the operational part. On the pricing crack part, we started April in a muted fashion in line with Q4 or March, something like that. May prices seems to be a little better than April, but on the pricing, the volatility is so high, every month it is changing drastically, and every $1-2 of crack more or less impacts the profit because there is a constant operating cost. So I think the guess on the cracks will not be feasible, but yes, on the operational side, that is fair and loss, we intend to improve further throughput. It should be more available. And on energy intensity index and benchmarks, we should improve further.
Wonderful, sir. Thank you very much. So it was a wonderful explanation. And one more question I have is that since you are, going in for a JV company with a huge, new refinery. So is it that you will be able to offer some kind of, opportunity by way of a rights issue or otherwise to the shareholders of CPCL?
At this stage, no decision has been taken, but sir, as you know, when we are finalizing the equity part, there will be multiple options which will be evaluated.
Okay. Yeah. Haji.
I think we were there on the right issue for CPCL shareholders.
Yeah, whether any participation we will be able to participate through a right issue of CPCL or anything.
At this point of time, we have decided the debt equity at 1:2, but all these are tentative. So pretty closer to the point, we'll take all capital structure related decisions. We have not firmed up anything as of now, But yes, any decision that is in the interest of the shareholders would be taken and communicated.
Okay. And sir, what is the final now, estimate of the refineries, capacity and the cost, structure?
Yeah, the new refinery is 36,000 approximately capital cost, 9 million ton capacity, million metric ton capacity, and petrochemical intensity of 6%, and which is PP, polypropylene.
Right. Okay, sir. Thank you very much. Thank you.
Thank you. Participants who wishes to ask a question may press star and 1. The next question is from the line of Achal Shah from Ambit Capital. Please go ahead.
Hello, sir. Just a question that, as you said about the 30% sourcing from alternative sources, like where we are getting discounts, how much of that is Russian and how much is from other parts? If you can give a breakup of that. Opportunity crude, sir.
Yes, I will not have an immediate breakup at this point of time. My people can connect, but even whatever I remember out of this percentage is not constant among crude types. That has fluctuated widely even during the year. So X crude, which could have been 30% or 29% at one point, could have gone to 18% at another point and would be replaced by another. So exact numbers I do not have, but certainly the team will revert back.
And sir, following up, the average discount for this opportunity crude will range in what, $3 to $4?
No, last year, that is financial year 24-25, the average was around 1.5 to 2. But it has gone to a high of 3 to 4 and to a low of less than 1 also.
Got it. Understood. Okay, sir. That's it. Thanks for your reply.
Thank you. Anyone who wishes to ask a question, please press star and 1. Anyone who wishes to ask a question may press star and 1. Ladies and gentlemen, you may press star and 1 now to ask a question. The next question is from the line of Harsh Raj Agarwal from Yes Securities. Please go ahead.
Hi, sir. I had a few questions which I got from some of the participants. I'll just go ahead with that. So we are present in the southern market, and we are aware that the market is in a shortfall. If you could cover some part of it, what is the shortfall and how it's going to pan out over the next few years given the demand is growing?
I'll tell you something which is very clear and crisp and very, very different. Like this southern market, in MS there is a clear shortfall. So the production is less than the demand. I think it's close to about 20 TMT, so that's per month. So MS, and that is how, if you see, in CPCL strategy, whatever little flexibility we have continuously tried to increase MS, we have continuously tried to increase ATF, so that we can take advantage of the demand scenarios and we can increase our margins. As far as others are concerned, we have seen the southern market to be mostly aligned to the national growth projections, little bit different. Like MS, they are projecting 6%. Here also we see around 4 to 5%. HSBC they see a 3% growth forecast. Here also we see about 2.5 odd. So in others we don't see much of a difference, but yes, in MS products are moved from other market to here. So that is how we have made constant effort to increase our production of ATF, which is a robust growth, as well as MS, which is in shortfall.
Thank you. So I have another question is on the RLNG piece. So we are consuming RLNG as a feedstock. So at what prices are they viable versus the alternative fuel like FO or naphtha?
So I'm happy to share with you, we do not consume RLNG as compulsion. So if you have seen 2 years before, whatever was RLNG consumption, almost we have doubled in 2 years. So we have kept dual feed system in most of our operation. Our compulsion is very minimal. It is based on economics, period to period basis. Cost of the feed, alternative feed, export realization, and the net cost, delivered cost of RLNG. these determine our LNG consumption. So if you have increased more, it means we have felt this is beneficial on economics angle. And also we need to keep in mind that close to our coast is a RLNG terminal, and we are connected directly through pipelines, and the southern coast is close to the international sea route. So all those advantages accrue to us when we account for our RLNG delivered cost.
Okay. So one last question I had, just wanted to understand your view on the refining market now. We have some shutdowns, some capacity addition, some capacity is going out. And in the Indian scenario, you have seen a lot of capacity that is coming up. You have HPCL, Rajasthan refinery, you have expansion at IOCL. So how do you see that market panning out over the next 2 years? The domestic one and the global in terms of the crack?
Okay. So in the domestic market, let me start with the domestic market first. As you have yourself said, no capacity is coming immediately. Maybe it will span over 2 years. In the next 2 years or little after that, those capacity will come up. And there is a PPAC projection. All these capacities are based on the demand, the foregoing demand. So capacities are coming in line with demand, and they will not come immediately. They will come after 2 years. And with respect to short-term shutdowns and all, the kind of monthly fluctuation that happens in GRM and others are actually based on short-term demand-supply gaps. So short-term demand-supply gaps do take care into short-term surplus or deficit of product, that the way people envisage here. Internationally also, though there are some capacities that are coming in Africa, predominantly, but there may be some other capacities will go off in some of the developed countries. So again, I will say, when people put up large capacities, long-term investment, it is based on demand projection, long-term demand projections, and long-term demand projection for the last some time is closely watched. So I feel that not having a significant impact on immediate or near immediate or medium term with respect to margins or GRM. But yes, margins and GRMs are not affected by a single factor, that is affected by multiple factors which change swiftly even within a short gap.
Thank you, sir. That was all the questions we had. I think if anything you want to summarize for the participants.
Thank you. I think it was very interactive. The only thing we'll tell is that CPCL refinery is perhaps one of the most complex refineries in India. It is the only refinery which has liquid fuel, which has loss base stock and wax. And because of our uniqueness, we are, we have some easiness where we are able to come up with new products quickly. Our team is, well connected with other research institutes, and we look forward to product development. And operationally, for the last 3-4 years, we have taken a path of aggressive improvement. Otherwise, you will not, find out where in a short span of 2-3 years, the fuel loss will come down by 3%, 2% kind of stuff. But yes, because we have taken an aggressive stand, we have been continuously improving. That is how these parameters are achieved. And the team is motivated. They will continue to make all in their domain to improve the operational excellence further. Thank you. That was from my side.
Thank you. Ladies and gentlemen, on behalf of Yes Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you.